Okay, everybody. So it's 11 o'clock. Welcome to the How to Finance a Startup webinar. My name is Juana Amaria, and we are very happy to have you today. Thank goodness it's Friday, huh? I want to go ahead and give you some tips for those of you that are with us for the first time. The best way to interact on this webinar is through the Q&A chat pod. We will have a Q&A session at the end of the webinar, but throughout the presentation, this is the way that you can communicate with us if you have questions, if you have technical issues. Sometimes you may have some problems with your own either the type of internet connection you have or maybe your browser. And so if you have technical difficulties, go ahead and call the conference call number so that you don't miss anything due to not being able to hear properly. So I'm going to go ahead and put this into the chat pod now so you have the number. Um, and go ahead and call if you have any issues. Now also, if you are on the conference call number, make sure to mute your computer speakers because you will have playback and then it'll just be really confusing and irritating on your end. Underneath the Q&A chat pod, you have a file share, and this is where you have all the PowerPoints. I emailed everybody as part of a reminder the PowerPoints for the webinar, but you also have the previous webinar PowerPoints on there as well as the business services flyer. Business services are services offered, and you'll notice a few people on the webinar today. The state of Illinois actually, through the WIA program, pays for business service team members and representatives to be available to help you with your business ideas. And so that flyer will walk you through kind of, what you need to do, and it's basically organized in 3 categories: hiring, training, and business services. And so that's the stuff that you need to build your business and so on and so forth. So what I'm going to go ahead and do is throughout the webinar, if our business service team members could just go ahead and introduce themselves and say, hey, I'm with this local workforce area. There is a find a location near you on the business pathway on Illinois WorkNet that will help you with a zip code search find the area in your find the center in your local area to put you in contact with people like Denise, for instance. Denise is one of the small business development centers on the northwest side of Chicago. And so maybe you're not in Chicago, maybe you're in Carbondale, and you could find a similar partner in your local area. So that's what you'll find in the file share. And the way to download it to your computer is you just go ahead and you highlight the file name, and then you'll have a pop-up window that's a new browser that will say download to my computer. On the right-hand side of that file share, you have some polling questions. And this is just a really great way, one, to get you to interact with your fellow business entrepreneurs, as well as give us some information on where you are in your process. So with that said, I'm going to go ahead and start the webinar. I do want to make sure that we have enough time to cover all your questions, and so I'm going to switch your screen for a second so you can see the PowerPoint better. Now what I wanted to mention is at the top of this PowerPoint, you'll notice that there's a full screen button that you can click. That makes the presentation the entire screen of your monitor, and that means that you won't be able to see the chat. So this is just another way for you to see a little bit better. Now with that said, here we are. So my name is Juana Maria. I'm the Business Services Coordinator with Illinois WorkNet, and I am located in Chicago. And our guest for the series on starting a business is Denise Ching, and she is the Small Business Development Center Director for ICNC. And some of you have already listened to all of our webinars, and so this part is very similar, but we're very happy to have her. She's been a wealth of information and really great way. I find that these series have been a really great way to get people to really start thinking about building their businesses, building their ideas, and finding out, what's my plan? How am I going to do this? What do I need to gain the kind of resources that they need to be successful? And so here's some information on Denise if you're curious about her background. And what I wanted to mention is that all the links in this PowerPoint are live links. So highly encourage you to reach out to us on LinkedIn, and I know a lot of people have done that with Denise as well. Go ahead and ask questions. Go ahead and collaborate with the other business owners on on the webinar today, because some people may be at a different place in their business plan than you are, and so it's a great place to collaborate and ask questions. We also have lots of groups with social media, so you'll notice on the business pathway that you can join the LinkedIn groups and talk to people. You can go ahead and follow us on Twitter, a good way to post jobs, and so on and so forth. So these are just a couple of the tools available to you to become successful and to get the information that you need. So with that said, I'm going to turn it over to Denise, and we thank you for coming on.
Well, good morning, everybody. Thanks for being on this webinar on a Friday morning. I know I'm excited that it's Friday. So we're going to go ahead and dig in and talk about how to finance a startup company. As you can see in our agenda, we're going to identify that there's different ways to bring money into your business to help it to get started and to grow. With that, there are some things that you need to understand as a business owner and an entrepreneur, which would be your costs and your profit margins and profitability, that sort of thing. And we'll look at the main financial statements that you would need to put together and project and understand as a business owner, which would be your balance sheet, your income statement, your statement of cash flows. So we won't make it an accounting session. You don't need to have like a bachelor's or a master's in finance and accounting. We'll keep it pretty basic, but these are things that you would need to know and understand as a business owner so that you can, make sure that you're profitable, that you're successful, and that you can make a case to an investor or a bank of why they should fund your business. So the first thing we're going to look at is equity financing. And that's where you would get money as an investment from somebody. So let's say you have an angel investor, or you're looking to go to an angel investor for $100,000 to help you start your company. What you're giving in exchange for that $100,000 of investment is a percentage of the ownership of your company. And so when you're looking at equity financing, what you need to keep in the back of your mind is someone is getting a piece of your pie. And so the types of people who provide equity financing are yourself as the owner, the founder of the company. It could be friends and family. Maybe you have parents or aunts and uncles or brothers or sisters who are giving you money to help you start your business. Those would be equity financing individuals. That would be angel investors, and on a higher level it would be venture capitalists. So the pros with equity financing is they tend to fund the risky transactions, which would be a business that's not necessarily proven. It's just a good idea. Usually they believe in you. Usually they believe in your business idea. They believe there's a market there. You can usually get larger amounts than a new business looking for a loan. And so those are some of the pros of getting equity financing. However, it is very difficult to obtain. There's only so much money out there that is being put out as investments, and so it can be hard to, kind of swim in that pool and make sure that you get the money that you would need. It also is an expensive form of financing because you are giving up a portion of your company and what your company would be worth. The other thing that you do need to keep in mind if you are going to bring in someone from the outside to invest in your company is there needs to be a clear exit strategy for that person, and what they're going to be looking for is a return on their money. So let's say, for example, you have that angel investor that you're looking to get $100,000 for, and you're going to give them 15% of their ownership. That angel investor is looking to get a minimum of 10 times his money, and so you would need to be able to kind of prove through your business case that with their $100,000 investment today, they'll be able to make $1 million, which would give them 10 times their investment. And so what we're going to look at here is valuations. I'm just going to go to the next slide. We're not going to go into in-depth into how to value a startup company. It's pretty subjective and creative, because you don't have a history of sales, so to speak. Some do, some don't. And so what you're doing is you're projecting, or you're looking at what you think might be the value of your company in the future based off of the market potential, based off of how quickly you can be profitable. And so when you have this investor coming in, giving you money to help you start your business, they're going to be asking themselves at the top, I have that quote, how much do I have to pay for a slice of the pie, and how big of a slice can I get? So if somebody is giving you that $100,000, and let's say you're going to give them 15% ownership for that $100,000, that means your company at that time needs to be valued at about $150,000, or I'm sorry, $650,000, because that would be 15%. So 100,000 would be 15% of about $650,000. So you're also proving if they're looking to make $1 million, which would be 10 times their investment, you would need to show that the future value of your company would potentially be $6.5 million. And so some things to also keep in mind when you're thinking about what the value of your company would be is, comparables. So how much are other companies being valued at in your geography, in your industry, in your stage of business. You also want to look at how quickly you'll be able to be profitable. Will it be within 1 year? Will it be within 5 years? Will it be in 7 years? And then the main thing is, though, the golden rule, which is he who has the gold rules. So a lot of times a startup's value is based off of the investors saying, this is what we think your company is worth. And because they have the money, they tend to make the rules. And that would be, a market-driven valuation. So the other way to finance your company as a startup is really to use your sales. And so that would be kind of like what would be considered retained earnings. So if you're pricing your product, and you're making money off of it because you're put in that you would make 50% margin. So let's say you're selling something for $100, but it only costs you $50 to make it. What you're going to do is you're going to take that $50 that you're making on your product and you're going to save that, and you're going to kind of build yourself a cushion. And what you do is you start off small, and as you build up your savings from making those sales, then you start planning your growth and planning your expansion, and you start adding things as you have the funds to be able to pay for that. So the benefits of that is that you keep all control of your company. So you, as the owner, as the founder, entrepreneur, you have complete control over your company. You don't owe anybody anything. It does allow you some time to develop your business, develop your model, your concept, to prove that it really works. You're not going to lose you're not going to lose money on a loan. You're not going to lose an investment. You're not going to lose a lot of your own personal savings that you're putting into the business venture. You're really allowing the business to bring the money in, so to speak. The con to this would be is that's not necessarily realistic for all types of businesses. Some businesses, there are some very legitimate startup costs, and so if you can get around it and try to self-finance by starting somewhere smaller and then building to that larger goal, like let's say a retail, like a restaurant, maybe you start off with catering, which is where you use a shared kitchen, and maybe you make some packaged goods that are sold in grocery stores, and then you build up enough savings and investment and sales so that you can then later have your own restaurant or your own food manufacturing center, but you start using an incubator and then you move to that. That would be one way to do it, but it's not always, like I said, it's not always realistic for all businesses to start small and grow larger. Probably the most common way that people use to help start their business is to use debt financing. Debt financing is typically the least expensive form of financing because you're just paying interest on the amount of money that you're borrowing from a bank. It's usually easy to obtain. However, it can get you in trouble if you take out too much debt to finance your business, and it does strain your cash flow. You do have monthly commitments to make those loan payments every month, whether you have a lot of sales or you have low sales, and so that's where having too many loans can really hurt you as a company because you have to make those monthly obligations regardless of how much money you're bringing in terms of sales. So there are different types of debt tools out there. One would be a term loan. A term loan is a set amount that you get up front. So let's say you get a $50,000 loan to buy some equipment and use it for a little bit of working capital. That would be amortized over the course of, say, 5 years. So you would make a monthly payment, it's usually fixed. You have an interest rate that would be fixed. And so you would make that monthly payment every month for 5 years. And after that 5 years is over, your loan is completely paid off. So usually if you have a building purchase, it's going to be amortized 20 to 25 years because you're probably buying something that's almost $1 million or more than that. So it's going to be amortized like a mortgage, like if you were buying a home. But most business loans for other purposes are typically 3 to 5 years. Lines of credit are like if you think of a home equity line of credit or a very, very large credit card. They're revolving, meaning you can use it and pay it off and use it and pay it off multiple times over and over. And those are used for short-term gaps. They're particularly helpful for buying inventory or raw materials because if you have that production time or that sales time, typically what you'll have to do is you'll have to pay your supplier, but you aren't also always going to have the money available from your clients because maybe you haven't sold through all the inventory, or maybe you're waiting because your client, your customer has a month to pay or 2 months to pay you for their order that they ordered from you. And so what that line of credit does is that it gives you the ability to draw from that line to pay for your bills while you're waiting to get money from your clients. It also can be helpful for payroll or seasonality. If you have a business that's very, very busy, let's say in the summer or in the winter months, but then it's slow on the opposite months, then it allows you to kind of float that time where you don't have as much sales, but then when the sales do come in and you're busy, you're able to pay that off. And then credit cards are usually pretty easy for a small business to get, and they're usually supposed to be used, again, for smaller purchases such as entertainment or travel, maybe some small office equipment, office supplies, and again, it's to be used and paid off on a regular basis. Um, I put on there as one of the cons is where debt can be misused, where it would restrict you from future credit. And it's really when you start using the lines of credit and the credit cards and you max them out and you don't have a plan to pay those off, that's where you can really hinder yourself from future availability of credit because now you're showing that you have these balances and you won't be able to qualify for credit in the future until those balances are paid off. And so it's important to know that if you're going to be making some large purchases up front, if you can get that in that term loan and have that where you're committed to those monthly payments where that loan will be paid off in 3 years or 5 years, that then you're not using those revolving lines to pay for something that's a larger scale. So debt financing, when you're looking to apply for a loan, whereas an investor is looking for market potential because they want to make a multiple off of the money that they're giving you. So, if they're giving you $100,000, they're looking to make 10 times that. So they want to see that you have a market potential to grow your business so that they'll get $1 million in return for that 100,000. What a bank is looking for is just to be paid back. So they're looking for your ability to generate enough cash each month from your business so that you can make those monthly payments and pay off that loan. So they are looking to make sure that you'll have some stability in your company, some future growth so that you'll be able to continue to make those payments over the next 3 to 5 years. But they're looking for what's called cash flow. They want to make sure that you have enough money coming in from your sales, that your expenses are low enough that you'll be able to make those monthly payments. And so what they're looking at typically in underwriting are what's called the 5 C's of credit. And that would be your character. Character is really the ability of someone to meet their obligations. And so they're looking at anyone who has 20% or more ownership in the business, whether you have on your personal credit, are you overextended? Do you have anything in collections? Have you claimed bankruptcy in the past? Are you in a foreclosure? They're going to look at your personal credit for anyone who has 20% or more ownership in the company. They're going to look at collateral, and collateral is just something like a piece of equipment or a building or maybe some inventory. It's a real good or property. And what they do is they put a lien on those pieces of collateral to say, well, if you should default on your loan, then what we can do is we can take that property away from you and we can sell it and try to recover our money by taking your collateral. Capacity is your ability to pay the loan, and so that's where they're going to look at your cash flow. Usually the minimum ratio is 1.25%. That's the minimum that they're going to look for. So they're going to add up all of your expenses, including your loan payment, and they're going to look at and say, do you have enough sales coming in each month to meet all those obligations plus have a little bit left over? And so they're looking for your sales to be up 125% of your expenses, including the new loan payment. They're going to look at the conditions of your business, and that's more of like the business environment, the industry that you're in. Are you in a high-risk environment? Are you in a high-growth environment? Are you in a highly regulated environment? So they're looking more at the conditions of the industry that you're in. And so what you'll see too is that some banks will not lend to certain industries because they feel like they're too risky, or some will specialize in certain other industries because they have an expertise in it. And that just takes a little bit of shopping around to find out which banks like certain loan products in certain industries. And then capital, what they're going to look at is how much money have you invested as the owner into the company. And this is where they're doing that, what they call the skin in the game. They want to make sure that they're not the only ones on the hook if something goes wrong with the business and the business goes under. They want to see that you as the owner have some type of skin in the game, that you would be out financially if you walked away from this business. And so typically a good resource for a startup company when you're looking to finance your business by using loans or debt financing are SBA loans. And the SBA stands for the Small Business Administration. It's a federal agency, and they're not a direct lender. What they do is they provide incentives to banks to lend to businesses. And they do that through two different loan programs. One is called a 7A, and the other one is a 504. And so what they do, 7A is their largest program, and what they do is they go to the banks, and the banks say, okay, Mr. Borrower, we like you, but because you're a startup business, we feel that's a little risky, and so we'll do this loan as an SBA guarantee. And so they'll lend you the money, and then the SBA, they sell that loan to the SBA as a guarantee. So if you should default as the borrower, then the SBA will pay back 75% of that business loan. And so the bank is not completely at a loss should the business go under. And so that's how they provide loans. And so you would go to a bank who's an SBA lender, and they run you through their conventional underwriting. And if you have maybe one of those 5 Cs, you don't meet one of those 5 Cs, then what they'll do is they will allow you to have the loan, but with an SBA guarantee to it. And there are some fees involved for the bank and for you as the borrower by having that guarantee by the SBA. The other loan program that they offer is what's called a 504 loan, and that is financing provided for fixed-term assets, which would be large pieces of equipment. Typically, it's used for buildings, so if you're buying a building for your business. And what that allows you to do is to put less money down in a transaction. So if you're going into a commercial loan transaction, typically a bank is going to finance 65 to 70% of that purchase price. You as the business owner would then be responsible for putting 30 to 35% down. With the 504 program, what you would be doing is the bank would only be financing 50% of the transaction, and then the SBA, through a certified development company, would finance 40% of the transaction, and you as the business owner would then only have to put down 10%. So it saves you a significant amount of money up front from having to put that into a down payment. Allows you to use that money for working capital or additional build-out costs or for growing your company. It allows you to preserve that cash. And it is a fixed-rate loan, and the interest rates tend to be pretty low with that. And so as a new company, kind of the main thing that is against you when you're looking for debt financing is you don't have any sales history. So there's no way for a bank or a lender to say, well, we know how much they'll be able to make because historically they've made this much money. And so that's where your alternative lenders can come in and be really helpful. They tend to be microlenders. Microlender just means that they lend small amounts of money. And when you're talking about business loans, that's usually less than $50,000. So $50,000 is a lot of money, but when you're talking about business loans, typically that's considered a small amount. So your microlenders are usually going to provide anywhere from $500 to maybe up to $25,000 or $35,000, as high as $50,000. And you can access those people. They tend to be what's called a CDFI. That's the acronym for a community development financial institution. Those are usually credit unions or other mission-based lenders who are out there lending to businesses who normally would not get a loan from a bank.
Denise,
Yeah.
would you consider, I'm not sure what they're called now, but in the past, like a shore bank would be like a microlender?
So Shore Bank is a community development financial institution.
Yep. Mm-hmm.
And yeah, and those funds are actually provided by the U.S. Treasury Department, and they provide grants to financial institutions so that they can lend to people who normally would not qualify for credit for various reasons. Sometimes it's because they're a nonprofit, and as a nonprofit, it can be a lot of banks won't lend to nonprofits. And so it really depends, or because they're focused on a particular community. Usually they're in low to moderate income communities, and they're serving a particular population that has historically been denied credit.
Mm-hmm.
And so, yeah, Shore Bank would be part of one of those lenders. Axion, Chicago, and the Dubin Micro Center, those are the ones that I use the most frequently with the small businesses that I meet with. They provide small loans up to, Dubin Micro Center does $15,000 maximum. Axion does $25,000 maximum. But they also provide business support services as well. They fund businesses who normally would not get approved by a bank because they're so new in business, or maybe there's a credit glitch on behalf of the business owner. And so they're really, really good resources for small businesses looking to get started who wouldn't qualify with a bank. Typically, and when I talk about banks not qualifying small businesses, the primary reason right now is because they're looking for a business that is anywhere from 2 to 3 years in operation already. And so if you're a startup and you're not in past that 3-year mark, you've already cut out quite a few banks that you can even ask for because they won't give you a loan being less than 3 years in business. And that's where your Axion and your Dubin Micro Center or some of these community development financial institutions step in. They step into those early stage companies. The other way that has been gaining some popularity in the past couple of years since the credit crunch is peer-to-peer lending. Now, sometimes this is through a loan, and sometimes this is through people just giving you money to start your business. It's really how you structure it. And business owners are using websites like Kickstarter or Indiegogo to facilitate that transaction with their friends or their families or outside investors. And so peer-to-peer lending is also another good way to get some money to help you start your business. If you're doing it as a loan, usually what you're doing is you're paying interest on the money that they are lending to you. You're having set monthly payments, and you have a set time of when you'll be paying them back. If they're just giving you money, then obviously it's not necessarily considered a loan. It would be more of a grant. Currently, right now, you're not allowed to give equity in your company for an investment that you get online through a Kickstarter or Indiegogo. I know there's some talk through the SEC of how that's going to happen. So it's a kind of a rapidly changing environment right now, this online fundraising. So the last thing that we'll touch on are grants and awards. That's probably the number one question that I get asked in a small business development center is, what grants can I get to start my business? And usually my answer is there are none because there really isn't a grant to start a business. There are grants for small businesses, but they're pretty limited, and they're very limited in the sense that there's not a lot of money available, and limited in the sense of the scope and what you can use it for and who's eligible tends to be very, very narrow. So typically what what I'll do and some other small business development center directors do is we really try to see if people are eligible, and then we can help you with those opportunities so that you can get that funds. So the people who issue grants to small businesses, the federal government does it through one way. It's called a SBIR or STTR, and those are research grants. They are given out by 11 different agencies um, and departments, such as the Department of Defense or the National Institutes of Health or the National Science Foundation, Department of Energy. There's several others. There's 11 in total. And what they do is they put out solicitations for, let's say, cancer drugs or robotics or clean energy, and then you as a small business can apply for those funds to develop, to do some research and development of a product. It's a very competitive application process. It's a very arduous process in terms of the amount of paperwork and planning that goes into it. But you can get the funding that you need to really develop some real science behind some innovative products that you would be looking to do if that's part of a industry that you're involved in. More of the grants that are available to small businesses come from local governments, and that would be your state government, city governments. Some of the more popular ones that we work with would be ETIP. ETIP is a training reimbursement grant provided by the state of Illinois, and it's for certain trainings, so not all trainings are reimbursed, but it's a 50% rebate on providing training to your employees. So let's say they needed to learn a new ERP system because you're a manufacturer, or they're learning QuickBooks, or they need to learn some type of forklift or sanitation certificate. Those types of technical skilled trainings, and if you're paying for those as an employer, you can take advantage of the employment reimbursement grant. SPIF, which is the Small Business Improvement Funds, that is a city grant. That is for small businesses who are located in TIF districts that have money allocated to the Small Business Improvement Fund. And that is a rebate grant as well, where you can get up to $150,000 or 75 to 50% of your project reimbursed by the city for doing roofing, tuck pointing, windows, HVAC. It's any type of structural improvement to your building. And facade rebate is a very similar program. It's kept at $10,000, and it's for improving the outside of your building for a business that's not located in a TIF district. And so those are a couple of examples of some local grants that are available. Some nonprofit organizations will offer grants. NACE is the National Association of the Self-Employed. If you are a member of NACE, I believe it's like $15 a month. They have a couple of different levels, but if you start at their basic level, you can apply for their grant. They grant out up to $5,000 per business, and you can apply through them. They don't have a lot of restrictions on what you can use it for. You're not limited to use it for training. You're not limited to use it for improving your building, and it's not a reimbursement. So that's one of the more popular ones that I refer people to. And then some corporations will put out grants from time to time, like Intuit earlier this year had one on, vote for your favorite small business, and they would get a grant for, I believe, a couple $1,000s. And so you just have to kind of be out there on the internet searching to find out what's available. Business plan competitions is another great way to get free money by submitting your business plan ideas to these different competitions, because usually those competitions have some type of monetary award to those who come into the first, second, or third place. And so the pros with getting grants or awards is that they don't need to be paid back. They're completely free. You're not paying interest on them. You're not giving up equity in your company. You don't necessarily have to build up your sales to get that money. It is free money. The cons are they're usually very, very specific in what you can use them for and who can apply for them. They're usually limited funds available, so usually it's like a first-come, first-served basis, or you have to wait for funding rounds to happen because they get exhausted. And a lot of times they are small amounts. They're usually $5,000 or less. So next we're going to move into looking at costs and calculating profit margins. And we're going to keep it pretty basic. I'm not going to teach like an accounting 101 class, but you do need to understand the difference between your costs and how you calculate your profit. And so this is a really big slide with a lot of text. I really put that in there for anyone who's going to go back and access this webinar, so you would have these definitions. But we're not going to read through all of that at this moment. I do want to point out that there really are two types of costs that you have in your business. You have variable, or what's also called direct cost. You also have fixed or indirect costs. So variable and direct means the same thing. Fixed or indirect means the same thing. So you have these two different types of costs in your business, variable or fixed. And variable costs are costs that you have only because you have a sale. That's your raw materials. That's your inventory. That's labor, wages paid on labor for making a product. That would be commission that you pay for a salesperson. Your fixed costs are costs that you have regardless of sales. So that's your rent, that's your utilities, that's office personnel, that's loan payments. So it would be anything that you have that expense whether you have a sale or not. And so understanding the difference between those two costs can really help you when you're pricing your product. And your contribution margin, or it's also your gross profit margin, is that difference. So when you have your sales coming in and you take out that variable, those variable costs, what you have left over is your contribution margin or your gross profit. Your break-even point, which is also a really important number to know, is what point do you have to have? What's your total sales that you would need in order to be completely equal, to cover all of your expenses, whether, your total expenses, which would be your variable and your fixed costs. And so your break-even point can be expressed in units or in dollars, and we'll look at that in just a minute. So I'm going to show a picture. I think this is really, really helpful when I was trying to, learn different ways of how to express accounting terms. I found this to be a really, really helpful diagram. So if you think of your sales coming in through a big giant hose, right? We all want a big giant hose, not a little trickling faucet. But your sales come in, and the first, let's say it goes into a big bucket. So the first bucket that you have to fill up are your variable costs. Those costs that you have because you had a sale. That's your, your inventory. So if you are doing a 50% markup, so if you're buying inventory, that's your immediate variable cost. Once you take those out, only that next amount, that contribution margin, is going to go, and that's going to fill up your fixed cost bucket. That's going to take out the rest of the money, and then what you have left over are your profits. So if we look at that with just some numbers, and I kept it pretty basic. So let's say you brought in $100,000 in sales, but it cost you $30,000 to get that $100,000 in sales. So your contribution margin would be $70,000. Let's say your fixed costs are $50,000. So then your net profit at the end would be $20,000. So for every $100,000 you have in sales, you're only making $20,000 of profit. And so to get those percentages that I have on the right-hand side, what you're doing is you use sales. Sales is always considered 100%. And then you would just divide the number that you have for your costs by that 100% sales. So that's where you get the 30, 70, 50, and 20. Looking at things in terms of percentages can be really helpful because it can really kind of take out if you have a really big number or a really low number. If you compare percentages, it really helps you to get a more clear picture of if you're growing or if you're going backwards. And then at the bottom, if you look at your break-even point, so if you added up your fixed costs, which would be $50,000, and your variable costs, which would be $30,000, to break even, you would need to have $80,000 in sales, or let's say each unit was $10, you would need to have 8,000 units just to break even and have no loss, but yet no profit. So your income statement is a really important financial statement. what this does is this is a type of, I put on here, it's like a report card. Usually your income statement is generated on a monthly basis. Then you would also look at on a quarterly basis and then definitely on an annual basis. And your income statement is best looked at in terms of percentages. So when you have your sales and your expenses, you would want to divide everything, have your sales set at 100% and then divide your expenses by that 100% to get those percentages and compare percentages over time will really help you get a better picture of your financial performance. So what your income statement shows you, it shows you if your sales are going up and down, shows you if you're making a profit or if you're having a loss. It also shows you how much your expenses are. So it'll give you your total expenses, and it'll show you how much money you have left over to grow your business if you have that profit. So a sample income statement, and I'm sorry it's kind of small. I tried to find bigger pictures, but it was a little difficult. We'll have at the top, you'll have your sales. Then you're going to have your variable costs. So it looks very similar to what we were just looking at. Then you're going to have your gross profit. After that, you're going to have your fixed costs, which would be your operating expenses. And then you have your total expenses. And then at the end, you have your net profit or loss. So another financial statement that you would need to have as a business owner would be your balance sheet. This is going to tell you what your company owes, which is your liabilities. It's going to tell you what you own in terms of your assets, and then it's going to tell you the net worth of the business. So once you paid off all of your liabilities, what you would have left over. So a balance sheet is going to tell you the net worth. It's also going to show you if you do have loans, how much of it is going to be paid within the first year or within that current year that you're in right now. That would be your current debt. And then whatever is going to be paid more than 1 year out, that would be your long-term debt. So it can show how debt-heavy a business is. It also, when you start getting into more financial analysis, a lot of your financial ratios come out of your balance sheet, like your quick ratio, your liquidity, your um, um, all kinds of different ratios like that. We won't go into that. That's too much today. But a lot of those percentages come out of figures that are on your balance sheet. And your balance sheet changes every time you have a transaction because it's going to show your cash. It's going to show you accounts receivable. It's going to show inventory. And so when you sell things or when you make a payment or you receive a payment, it automatically changes your balance sheet. And so if you have an accounting software for your business, such as QuickBooks, it does all of this kind of behind the scenes. So as you enter transactions, what QuickBooks does or any other type of accounting software is it automatically generates these types of accounting reports and financial reports. You can use Excel to create new balance sheets. So if you're a brand new business, you're not already in operations, and you want to say this is what I think my business will do, you can easily use Excel to create a balance sheet, an income statement, or a cash flow statement. So if you are planning on getting a loan and you're a new company, what you'll want to do when you're projecting your balance sheet is to show that loan, that you would be getting that loan. Put that in your balance sheet. And this is a sample balance sheet. You have your assets and your on one hand, and this is where it balances like an equation. So your assets are going to equal your liabilities minus your equity, or plus your equity. So usually your liabilities are a negative number. So what it's going to do is it has to balance. So if you are putting together a projected balance sheet, you want to make sure your assets equal the liabilities and the equity. So your statement of cash flow is usually done on a monthly basis, and what it does is it shows you money coming in and money going out. If you think of balancing your checkbook, and you have so much money that comes in through your salary or your wages, and you have so much money going out in terms of your bills, and some months you have larger expenses, some months you might get a bonus, or you get your tax return or something like that. So your statement of cash flows is going to show that difference where each month Some things remain the same, but some things vary. And it shows you whether you have enough money to cover all of your expenses that month. And so for a new business, it's really important to look at what you think your cash flow is going to be like each month. Are you going to build in when you will have enough sales to cover all of your expenses? Are there some months where you're going to have higher sales, or are there going to be some months where you're going to be slower and you're going to have lower sales? And you need to be able to answer how you'll be able to afford loan payments or rent when you have, this fluctuation of sales coming in and out. Or if you know there's a month where you have to pay certain registrations, or a month when you have to pay taxes or something like that. What your cash flow is going to allow you to plan for those fluctuations in money coming in and money going out. And so this one's really, really tiny, but it's actually very similar to the income statement where it's structured. It's just you're going to have each month, where typically with an income statement and a balance sheet, you're just going to pull it for a particular period. You would pull 1 month at a time, and then maybe you would compare months next to each other. Your cash flow statement's going to have, January, February, March, April, May, all the way through the end of the year. And as you end 1 month, you're going to take that balance and you're going to move it over to the top for your cash on hand for the next month. And you're really just looking at cash coming in. So it's not necessarily an accounts receivable promise to pay within 30 days. You're only going to show the money that actually came into your bank account, and the money that is actually paid out to a vendor. So you're not going to show accounts receivable and accounts payable. You're just going to show money that's directly going in and directly going out. But it is set up similarly where you have the sales and the cash coming in at the top, you have your expenses, and then you have what's left over, the net balance at the end. So just to kind of wrap up before we go into some questions, when you're looking to bring in money or to fund a business that is being started, you really want to understand how you would use the different types of financing, because financing is really a tool for you to grow your business. And so are you looking to rapidly expand and sell your company to another business and make money that way? Then you might want to be looking at an investor, because then you'll be able to really get larger amounts of money to grow your business at a very rapid level. But are you looking to keep your business for yourself, and are you just need a piece of equipment, or you're looking to just get a little bit of working capital to get started? Then you might want to look at doing a loan. Are you able to scale your business? Are you able to start small and grow bigger in a pretty good way? And so then maybe you want to just self-fund by just producing more and more sales. Either way, there is no necessarily right or wrong answer. It really depends on the type of business that you want to develop and what you need, and understanding how to use the financial tools to help you get there. You do want to make sure that you understand the difference between the costs and how you can price yourself, so that you don't price yourself so low that you need to sell so many units that you won't be able to cover your fixed costs. You want to be able to price yourself accordingly so that you can make money in a reasonable way. You also need to have your financial statements projected for at least 3 to 5 years, and you will need a business plan. If you are looking for an investor or for a bank to fund your business, you need to have a written business plan with those balance sheets, income statements, and cash flows projected out for the next 3 to 5 years, showing that your plans to grow and expand your business, and showing that you'll be able to give them their return on their money or be able to pay them back the loan that they're going to give you. So with that, we'll just kind of open it up to some questions. There's probably a lot.
Absolutely, and I'm going to go ahead and open the phone lines so that you can get in queue. And so it's *# for those of you on the phone if you want to ask a question. And
the floor mode is on. To request the floor, enter star, then pound.
I noticed that there were quite a few questions, and so the first question from Bert was, my idea is not conventional. My credit used to be great. All in all, I do not think I can get a loan. Any help from me? It would be a home-based business, has to do with real estate. I did go to the WIA to upgrade my skills and have not been hired full-time yet. Um, so for those of them that are starting a new business because it's based on the economic turmoil, what would you say, Denise, in trying to find the right um, loan, or how would you go about doing that if maybe you don't have stellar credit?
Sure. So credit, usually that will put you in that alternative lender um, where you would go to them because those are usually the people that they help with loans are the ones that maybe you've maxed out your credit cards in the past, and so now you don't have the ability to and it just knocked your credit score, personal credit score down a little bit, but you have a great business idea. Um, the only thing is if you are in real estate, that typically is not funded on the loan side because there's not that stability that you'll get paid every month. That's usually one of the ones that is not funded. It's like a restricted industry. And so you're probably going to have to try to do it yourself and do the self-funding. Usually the only way you can get real estate loans is if you are able to bring you're buying a building and you're bringing some money to the transaction. And if you are a business and it's for business purposes and it's going to be owner-occupied, you can do the 504, but there really isn't loans for, or, SBA loans or alternative loans for like investment properties. You just
Right.
kind of have to do that yourself.
Uh,
Sorry.
no, I mean, that's kind of the reality of how it works.
Mhm.
The other question is they were talking about accountants and reading balance sheets, and I think along the same lines are, for instance, if you want to start a website for your business, and the question was, how do I get more information, or how do I, learn to do this stuff better? And the suggestion I put in the chat pod was, you don't have to become an expert in everything when you start your business. And so could you give them pointers on, okay, maybe you're not really good at accounting, or maybe you're not a computer person. Um, how do I get that stuff done for my
Mhm.
business?
That I think that's a great point. You don't have to be an expert in everything to run your business. As long as you have a general idea of how to use it, that's more of what's important is so if I look at an income statement, what do I need to look for in order to use this to make a decision to grow my business? Because you can actually have somebody do some of the manual work for you, and I would say getting an accounting program like QuickBooks, and I just use QuickBooks because they have free versions online, and they also are, they're one of the industry leaders, and I have a little bit more experience with that. It does all the accounting for you behind the scenes. So you're just really using it to record your transactions, and so you don't have to worry about doing, like a debit and a credit, and is
Right.
this really going into
Old school
my current
accounting
assets?
class.
Yeah, it does all the accounting for you behind the scenes, and then all you do is you click on reports and you click on income statement, and boom, it generates it for you. And so it's more about the data entry. And I would say, so getting tools that will kind of do it for you, and then I think just using free resources. There are different classes or things that you can just, I think if you just look at things over and over and you hear things over and over, it just kind of starts to sink in. If you really want something more in-depth, you can take a class. I think even some colleges allow you to audit classes if you wanted to take like a college level class. But you can always take a very basic accounting or finance class. I would probably say accounting is more of what you would use. Finance tends to be more about how to calculate financial ratios, um, and valuations and that sort of thing, which could probably be more complex. But just understanding what's a expense, what's a revenue. So even just looking through like some definitions can kind of help you, and how they relate to each other. And you can get those resources online. You can come to different centers. And I would look into using some accounting software to help so you don't have to do it yourself manually.
Right. What about for, and we haven't covered this before, but for people that are looking to get help, like doing their website, for instance, they're starting their business, they're doing it from their home, and the first thing that people think of is, okay, how do I do this? I don't know anything about websites. Like, what would you say? Like, what are some of the resources, free resources out there? Like you said, QuickBooks is free online. You could find, um, software. But what about, like, groups that help small business owners start websites and all of that?
Mhm. So free resources would be like, so small business development centers are actually all throughout the state. There are a number in the Chicagoland area, and we meet with people individually for free and give them business advice. And we also have different classes. But I would say if you just need to put together a website for your company, there are free resources. A lot of people I know and some companies, they'll use WordPress, which is like a blog-like type website. You can use WordPress. You can also use Blogger or TypePad, or you can subscribe to, I think Weebly is another free one. And a lot of times they give you like a template, but you can upload your own pictures. And so all you're doing is, it's almost like typing in like a Word document or a PowerPoint. You don't have to know code, but you can still put together a really attractive, user-friendly website for your company. And you might have to pay maybe $10 or $15 a month to have it hosted, but typically they're either free or they're very inexpensive, and you can kind of do it yourself in a very easy way. Again, you don't need to know code. You just need to know how to like use a text box.
Right. And then you would pay for your domain name or whatnot.
Right.
And
You would register the domain name.
yeah. And so, um, someone else asked, Denise, what are the business types that banks would fund? So what are kind of the top business trends that banks look to finance?
So banks love professional service companies like a doctor's office, like a law firm, someplace that gets checks, that has the potential to have, steady income every month. They love manufacturers. Anybody, like I said, who has like kind of like a steady revenue, has predictable profit margins. So manufacturers, professional services, trying to think, those are usually the two most popular. Some retail, although some retail can be a little scary for some of them because of the fluctuation and the high overhead costs, which would be your high fixed costs because you have to have rent in a store and insurance, and then if you don't sell your inventory, um, you can be in trouble. But professional services and manufacturing and industrial companies are usually the most liked by banks.
Okay. Um, Bernie asks, are there any programs with the state or the federal government that sets aside specific contracts that helps provide cash flow? These contracts need to fit the business plan.
So I guess I'm not sure. So contracts that meet cash flow for...
Right, so to create like a cushion for the business to have cash flow, and I don't
Oh, no.
know, yeah.
Sorry. Yeah, actually, you need to be pretty healthy as a company to do a government contract because governments can pay really late and they can pay really slow. And there are businesses that have gone out of business by doing work with the government. So you need to be pretty strong in your ability to deliver and wait for payment for doing government contracts. There are set-asides for small businesses, for minority and women-owned businesses, and you have to get certified for those. But again, it's a lot of work to go through the certifications. It's not necessarily a guarantee that you will get the business, but I would say you need to be pretty strong financially to go after those contracts.
And then the question was, there are three messages, WordPress, Blogger, and Weebly. Those are the three websites that we were mentioning before that you could create your own web page so that you have at least, a starting point on having your website. But yeah, I mean, and Denise and I were talking about this earlier where you really have to make sure you have at least the funds to be able to pay until because it may take up to a year to get your money.
Mm-hmm.
So it's very tricky with that kind of stuff. Um, let's see, what any other questions that anybody, I see people typing. What are some more popular business investments for veterans looking to go into business? Actually, Tony, there's a whole part on the business resources page. I don't know how familiar you all are. I keep referencing it throughout the webinar, but there are special groups, actually veteran entrepreneurs, and under Getting the Help You Need on the business resources page, you'll have a link to that center, and that works directly with veterans. And so I'm going to go ahead and put in a link for you so you can see it. It's under the tab Business Assistance and Training, and it's called the Veterans Business Outreach Center. So I would highly encourage you all to look under the Business Assistance and Training because you'll have a link to the SBA, to the Women's Business Development Center that Denise mentioned, to SCORE, and other resources. Aliba asks, what about restaurants? What type of resources are available?
So
Denise, do you have?
restaurants, sure. Restaurants are usually one of those businesses that banks don't like to lend to because it's hard for them to have sufficient cash flow. You have a lot of expenses, and if you don't have enough customers coming in and eating from you, then that's partly why it's difficult to get lending products for business as a restaurant. Um, Really, I mean, you just have to have a lot of money to start a restaurant. It's a lot of money to build it out, to have it to code, to have the right concept and menu, and be in the right location to get people coming in. It's a very difficult business
Very
to start.
tricky.
Yeah, there's a lot of regulation because you are dealing with food. You do have safety for employees as well. So there's there's some classes, I would say classes learning how to manage and what's required for a restaurant are good. There's some at the City of Chicago through their Business Affairs and Consumer Protection Department. They'll put on free workshops. They also have a Talk to an Inspector's Day, which you can get a lot of information about what would be required or what you need to do if you're starting a food business and a restaurant business. They have a guide on the City of Chicago's website for how to start a restaurant, what would be required. I would use all the free resources to find out what you would need. And then if there is something that would help pay for it, like a facade rebate or a SPIF grant, those can help out too. But other than that, it's going to be a little difficult to find outside financing for that.
And what I would just continue to encourage is a lot of the resources that Denise went through today. If you really sit down and you go through the tasks of creating your financial statements and creating your business plan, and then just, like we have on that page, the hardest part about it's like really exciting to start your own business, and then it's really scary. But if you're diligent about your tasks and what you need to do, you'll eventually find the funding you need, and you'll get the help. You can get the resources for free, like we mentioned, and then just put it together and actually attempt to get the funding, so whether it's the alternative funding methods or through, peer-to-peer or whatnot, as long as you have a tight plan together, I think that that's probably the harder part because you can find somebody that'll believe in your business plan.
Mm-hmm.
So what I wanted to remind everybody is just go ahead and fill out the polling pods. Let us know, if this was informative for you all. There are future webinars. We wanted to know, what you'd like more in-depth information. Finding money is always a very popular webinar topic. So please let us know what else you would like to hear about. We're working on getting some other guests, on finding money and the different types of resources on marketing, and creating a marketing plan, which is just as important as finding money and so on and so forth. So please go ahead and fill that out. This webinar will be archived and available on the Business Resources page, and so I'm sure you're all familiar with it now. You go ahead and you scroll down and you'll have all the materials and the videos on the webinar there. So if you do have questions, go ahead and reach out to Denise and I, and we'd be more than happy to help you or at least point you into the right direction to get the help that you need. So if we don't have any other questions, thank you so much, everyone. And we will send a follow-up email letting you know what the next webinar topic will be for August. So we appreciate your time. Thank you, Denise.